I made a complete blueprint on how specifically I'm going to take advantage of this 2023 market crash.
Sounds interesting.
But not just by your measly 7%, I'm talking gains. Now, this plan is a 10-step plan, and each step is just as important as the next, so you can't skip any of these steps. If you take out just one of these steps, the whole plan collapses and fails. So what's the first step, you may ask? Well, to figure this out, we have to take a deep dive into what's currently happening in the market.
Just talk to the Treasury Department in DC. They're the ones who really understand how all this works. Oh, sell. Ah!
There are two sides. Some investors say this is the bottom. We are currently in the bottom as we speak, and the market is starting to reverse now. Then there's the other side, where they think this is simply just the beginning and we have another year or two before the market starts moving upwards again. So who's really right? Well, instead of just going off pure feelings on this, if this is the bottom or not, why not use factual data and statistics to see when the bottom is most likely to occur? Because if you find the bottom, you're gonna be a pretty wealthy So which side is right? The bulls or the bears? To find that out, we have to know why the market is falling in the first place. You can blame this guy. Sorry, Jerome. Jerome Powell is the chairman of the Federal Reserve, which means he's in control of the little switch that can control interest rates. Now, interest rates are a huge part of the market, and funny enough, we can use these to our advantage.
How are we supposed to do that?
I want you guys to look at this graph. In this graph, you can obviously see every time interest rates increase throughout history, the stock market goes down. Right now, we are in a downtrend throughout all the markets. And what do you know? Interest rates are increasing. So the stock market is down, crypto is down, the real estate market is down. I completely understand that rising interest rates are not the only reason for why the market is moving downward. We had the coronavirus, massive amounts of inflation, the Ukraine war, and so many other massive black swan events. But with that said, you cannot deny the fact that throughout history, more often than not, interest rates have a correlation with market movement. So interest rates are currently around 4.5%, which means investors are demanding a premium for investing in anything that's slightly more risky. So in turn, stocks and real estate look a lot less appealing.
That sounds disgusting.
Look at it this way. If I came up to you on the street and said, hey, I'll give you a risk-free guarantee return of 6%, or you can take your chances in the stock market for a maybe average of 7%, which would you pick? I think the answer is pretty obvious. So that's why the market for the most part is currently going down, which means there's an incredible opportunity right in front of your eyes. Which brings us to the first step of our magical plan. Interest rates start to rise. Now, like I said before, the Fed has already started to increase interest rates. So technically, our plan has already begun. So that's step one complete. Now, look at this. One study from Harvard analyzed investor behavior when risk-free returns were low and compared those to the same investors when risk-free returns were high. And the results, they were pretty interesting. So interesting, I had to add them to this video. Low risk-free returns cause significantly more risk-taking for higher yielding investments. Then it starts to level out once the risk-free interest rates are higher, even when the riskier investments still pay the exact same amount. So you might be a little confused right about now. That's alright. Let me dumb it down just a little bit for you. This study found if interest rates are at 0%, 70% of the average investor's portfolio went into riskier investments, driving up the price. So for example, remember when all those fun things were happening like Doge, GameStop, AMC, etc.? But what this study found is that if interest rates go to 5%, the risky investments went down to 50%. So this means most of the risk taking, like investing in stocks or crypto, occurs when there are low interest rates. Which, if you look at these past few years, this study holds incredibly true. Now, remember this statistic because we're going to come back to this later. So going back to the plan. plan. The first step is interest rates start to rise, which means when interest rates are rising, they are pulling money out of the market, which makes the value of assets go down. And when they lower the rates, they are putting money back into the market and the value of assets go up. So we can watch what the Fed does closely and predict what the market will do next, or even better, try to predict the exact bottom of the market.
We're gonna win, and we're gonna win big.
Now it's time to go into the actual nut and bolts of this operation, how to actually time when the market is most likely to bottom. This is including stocks, crypto, and Forex. While we're on the topic of Forex, have you heard of It's an amazing Forex broker that I absolutely love. They have insanely low fees, some of the lowest fees on the market. And on top of that, they have a bunch of cool Forex tools you can use for absolutely free, like a commission calculator, a margin calculator, pip calculator, and a swap calculator.
The calculator. The calculator.
They are doing a special promo right now. If you sign up with the link in my description, they will match whatever you first deposit. So if you deposit $100, they'll give you $100. It's that simple. Go sign up. I'm telling you, you'll love it. Okay, back to the plan. Realistically, it's only a matter of time before they start cutting interest rates because they can't really just keep raising interest rates forever. In fact, they can't even keep interest rates high for a prolonged period of time because they're going to force debt markets into substantially lower liquidity, and that's going to cause the price of assets to continue plummeting. This is not good because this is when recessions and depressions start happening and nobody's happy.
I think I just threw up in my mouth.
So eventually they're going to start cutting interest rates, and according to all of the data in history, it is fair to assume that the bottom of financial markets will follow reasonably soon once the Fed starts cutting interest rates. Which brings us to the next couple steps of our plan. 1 is interest rates start to rise. 2, interest rates start to slow down. 3, interest rates freeze. 4, interest rates start heading downwards. 5, the market creates a bottom and starts to reverse. So we just knocked out a lot of the steps from our plan. Now, I want to make this extremely clear. There are points in history where interest rates go lower and the market keeps falling, which if this happened, this would ruin our whole entire plan. So it's not exactly a complete foolproof plan, at least yet. So to be fair, the Fed probably isn't going to start cutting interest rates for a while. Then even once they do, it's not like the market is instantly going to start reversing the day they make the announcement. It will probably be another 3 to 6 months of lag after they announce they are going to cut the interest rates. So realistically, we probably won't see the actual bottom till the later half of 2023 or even 2024. But as you'll find out soon, that's actually fantastic news.
How is that good news?
So Bitcoin, as you may know, for the most part follows what the rest of the market does. If the stock market falls, crypto falls. If the stock market goes up, crypto goes up. Pretty simple stuff. So if interest rates start getting cut down around 2024 and the stock market starts to bounce back from the bottom, that lines up perfectly for this.
The Bitcoin halving.
A Bitcoin halving is an extremely important event in crypto because it basically marks the point at which the rewards for Bitcoin miners decreases. So every 210,000 blocks that are mined from Bitcoin, which generally takes around 4 years, miners get half the reward they were previously getting. This means less Bitcoin will be created and sold by miners into the market. So less supply for a very in-demand asset will cause the market to go up. And you guessed it, the last halving was in 2020, which means the next halving is going to be in 2024. Now, hopefully the little hamster in your head is starting to spin. As it looks now, all of these things are going to happen in around the same time, creating almost a once-in-a-lifetime opportunity. So let's go back to our plan. Once the interest rates start going back downwards, this is essentially when the bottom has been hit. This is when we start buying. Stock market starts to go bullish right around when the Bitcoin halving happens. then we get a massive crypto bull run. Now, I want to go back to that study that we were talking about before. Remember how I said people start investing in riskier assets when interest rates go lower? Well, see how that comes into play now? Once the interest rates lower, people are going to start getting more risky, investing into things like crypto, just adding more fuel to the fire. Now, of course, this plan is not bulletproof. There are events that can happen that can completely turn this plan on its head. Like if a country invades another country, or a deadly disease spreads throughout the nation. That would really f things up. So my point being, there are things that can happen that will prolong or speed up this plan. But that's why we're about to implement what I call the master plan. Yeah. That sounds pretty good. First tip, yield curve. The yield curve is a graph that outlines how much investors could expect to earn throughout 1 month to 30-year terms. And the longer you invest your money for, the more you should get paid. Makes sense, right? Well, when the yield curve inverts, short-term rates begin paying more than long-term rates. And this signals that investors seek more risk investing in short-term than they do long-term. So one study found that since 1993, the SPX bottom has never occurred until the yield curve was non-inverted, and today we are extremely inverted. So that's one way you can predict the bottom of the market. Next tactic we can use is the put to call ratio. If you aren't aware, a call is a bet that the stock price will increase, and a put is a bet that the stock price will decrease. And throughout history, once the market sees 1.8 puts for every call, on average the market reversed there. Another way you can predict the market bottom is with the VIX. This quote came directly from Morgan Stanley. Generally speaking, we do not see bear market bottoms without panic selling, similar to what was seen in 2001 and 2020. Historically speaking, no bear market has ever bottomed without a VIX reading of 45 or more. And sure enough, if you look at every time the VIX went over 45, the market bottomed and reversed. Then finally, the fourth and last tactic you can use to predict the bottom of the market is by using the good old 200-day moving average. When less than 20% of companies are trading above that 200-day moving average, the market is most likely bottom. But if you look at this chart, this statement holds pretty damn true. Every time it went below 20%, the stock market boomed right after that. Now sure, using just one of these tactics by itself probably wouldn't work so well. But if you use all four of these tactics in correlation on top of the interest rate plan we had before, it will give you absolutely great odds of finding the bottom. So if everything goes to plan, we can move to our last step of the blueprint, which is to sell everything and make a shit ton of money. In no way am I telling you to use this plan. I'm just sharing how my mind works during times like this and what I'm gonna be looking for. So that's my plan. In 5 years from now, you're either gonna look back at this video and think, God damn, that TradingLab guy's an absolute freak of nature as I'm in my Lamborghini, or the plan went terribly wrong and I'll be working at Wendy's. Let's hope it's the Lamborghini side.
Well, I hope you folks enjoyed yourselves. Catch you later on down the trail.